I'm Justin Boyd, President of Delta Financial Advisory. Welcome to our monthly market update for November 2025. Please note, as with any of our videos, this content is intended solely for general informational and commentary purposes only. Nothing discussed should be interpreted or construed as personalized financial or investment advice. For a more detailed disclaimer, please refer to the conclusion of this video. If you find value from today's content, please like the video and subscribe to our channel. Okay, let's get started. We noted in September that economic data continues to drive forward in a manner we viewed as supportive of a reasonably healthy economic backdrop. Market behavior since that time has certainly supported that general sentiment, particularly as reflected in continued earnings growth and price increases among the indexes. While there is divergence between Main Street economic conditions and Wall Street, those divergences haven't yet resulted in material price correction in major indexes. The divergence amongst the primary metrics we track suggests sluggish or uncertain magnitude of direction going forward. We would point out, however, that the sluggishness in the labor market should absolutely be watched closely and would be a driver of slowing aggregate economic activity should it continue. One thing we identified accurately and well in advance here at Delta Financial Advisory was the likelihood of elevated but contained inflation. We coined this phrase some time ago and have referenced it in previous videos on multiple occasions. With the latest data we do have, we've essentially hit our previously published target of 3% inflation. It is somewhat concerning that we see a re-accelerating trend amidst a general bias toward lower rates from the Federal Reserve. However, we maintain patience and further data points as we think this rising trend will be met with continued monetary restraint and the potential for further disinflationary adverse credit events. While we continue to view cap-weighted index pricing as materially elevated and maintain a moderate underweight of equities to ensure robust liquidity for our clients, we do not ascribe to an imminent downturn mentality. Rather, we simply acknowledge an increased possibility of this occurring, along with an increased likelihood of historically lower returns over the intermediate term. We continue to suggest that restrained optimism in equity allocation is the most prudent course of action for all but the most aggressive portfolios. Evident here in these M2 and bank credit charts is the moderating money supply increases over the last few months. Money growth remains below historical trend that's consistent with a 2% or greater inflation rate. Additional inputs that lead us to think moderating inflationary pressures are likely over the intermediate term include initial cracks appearing in the current credit cycle, nominal and real wages beginning to show weakness, as well as continued outright declines in rent and housing prices at the national level. Another topic we have taken a clear stance on here at Delta Financial Advisory and in previous videos on numerous occasions is the relative strength of the US dollar as measured by the Dixie Index, or DXY. While most fiat currencies consistently lose value against hard assets, and that has been particularly apparent of late when viewing the run precious metals have had, we have stood firm in our view that the dollar index was holding at critical support levels around the 96.50 level. It's now brushing up against critical resistance at the $100 level. The point being, our view on the dollar supported our view that short to intermediate term US debt remains an investable asset class, with the prerequisite requirement that some level of real return be delivered. To provide further context for viewers in terms of overall market valuations, as well as our process and disciplined approach to portfolio construction, I'll briefly touch on some data points we've identified during our normal research processes over the last several weeks. Our work suggests that the S&P 500, excluding just a few outliers to obtain more quality data overall, has an overall price to operating cash flow ratio of approximately 29 times, while 5-year average revenue growth has reached approximately 18% annually. When we include modest balance sheet quality expectations, the number of investable companies in the index shrinks to just under 200 names, with an average price to operating cash flow ratio of 35 times and a 17% 5-year average revenue growth rate. This offers an initial clear glimpse into capital structure decisions and balance sheet quality, or lack thereof, among many well-known names. Imposing a 14-time price-to-cash flow limit reduces the investable universe to only 26 companies, only 5% of the S&P 500, while 5-year average revenue growth stays above 14%. Though our research process goes well beyond these initial parameters, and we don't remain immobile surrounding any one metric, this provides an eye-opening view of overall valuation in today's leading index. Wrapping up with our current asset allocation, we maintain our equity allocation at moderately underweight. We've reduced index exposure in favor of select opportunities identified in pharma and biotech, and to a lesser extent, some commodity and consumer staple businesses. Ultimately, we're focusing on lower index correlation while accepting the potential for heightened overall portfolio volatility in search of commensurate total and risk-adjusted returns relative to declining risk-free rates. We continue to view cap-weighted equity valuations as materially elevated. Given a likely bias toward declining real rates, we continue to balance healthy amounts of liquidity with an increasing bias toward opportunities that arise in high balance sheet quality, profitable, and time-tested businesses. We maintain our fixed income allocation at moderately underweight relative to major benchmarks. Note a reduction in short-term Treasury holdings relative to earlier in 2025 to purchase select equities, as previously mentioned. I hope this video provided you with a better understanding of the current financial landscape and provided insight into how we manage client portfolios here at Delta Financial Advisory. If you gained value from today's video, please click the thumbs up icon and subscribe to our channel. If you think Delta Financial Advisory may be a good fit for you or someone close to you, reach out via the contact request form at deltafinancialadvisory.com. Until next month, we wish everyone health, happiness, and successful investing.
The information and commentary contained in this video are for general informational and commentary purposes only and do not constitute financial, investment, or other professional advice. Always consult with a qualified financial advisor before making any investment decisions. Investments carry risks, including the potential loss of principal. The content is based on current market conditions and is subject to change without notice. The firm is not responsible for any errors or omissions, or for any actions taken based on this information. Past performance is not indicative of future results. This material does not constitute an offer or solicitation to buy or sell any securities.